have a good, wonderful day. Happy learning to you all. So, today we will be learning on the final accounts preparation. So, we all must have learned the preparation of final accounts during our school days itself, in our class 1 and class 2 higher secondary schools. And we also learned the preparation of final accounts for different businesses like sole trader, partnership firm. But now we are going to learn the final accounts for companies. First of all, we need to know why does the company have special provision for preparing final accounts. Whereas if you take sole tradership, sole proprietor business, partnership firm, there is no special provisions made. Just everyone need to follow the accounting concepts and conventions every time. All the generally accepted accounting principles need to be known to prepare the final accounts for sole trader and partnership firm. That is enough, but for companies, they have a special provisions have been made in the Act itself to prepare the final accounts. So in this class, we'll be learning not only to prepare the final accounts for companies, but especially I will be giving more importance for why so much provisions has been made. What are the provisions? How it differs from normal final accounts from sole proprietorship or partnership firm. What is the reason behind that in preparing lots of accounts for every ledgers? So it's not like regular debit and credit. Why it is so? And what the Company Act says behind the preparation of final accounts? How do they give significance for different set of ledger accounts, which have to be prioritized, which have to be stated at last, which have to be in between? So on what basis they are prioritizing the different ledger accounts, either in income statement or in balance sheet? So today we'll be focusing on preparation of final accounts in public sector companies as well as private limited companies. Reason behind for each books of accounts maintenance. How to focus on managerial remuneration, whereas when we prepare the final accounts for sole proprietorship and partnership, we did not give importance for remuneration. So just like that, the sole proprietor will take some money as for their personal use. We call that as a drawings. Even there is a salary, they will describe as it is. If whatever they want, they will fix it and they will withdraw. In partnership firm, they used to have some deed and they will fix. But here, the computation of remuneration itself, the Act has given some guidelines. What are those and what is the reason behind those guidelines? Why do they need to follow that particular guideline? Why don't you give remuneration to board of directors or members of board just like that, fix their salary? But why the Act gives certain guidelines for computation of managerial remuneration? What are the guidelines? Why it is? And next is dividend distribution rules. So because when you take any final account of any business, the profit sharing do not have any specific rule. Partnership firm may have a deed, or even if it is not mentioned, they will share equally. But here, the profits have been shared to the proprietors in the form of a dividend. So for that, they need to follow some dividend distribution rules. What proportion can they give Can they give the entire profit as dividend? No. If no, why? And how it is segregated? And those things we will be looking into. If they earn 10 lakhs profit, can they distribute the entire 10 lakhs as dividend? Or they need to keep 2 lakhs for their business and 8 lakhs can they distribute dividend? So what proportion it should be better? In financial management there is a theory called dividend theory, dividend decision analysis, where there are different models are available. But here Company Act says some rules for dividend distribution. So that we will be looking at. Next, the preparation and presentation of financial statements. So how it's based on what basis it should be. So we know the concept called marshalling of accounts. But now the marshalling is going to be in different way in company accounts. So on what basis they have been stated the different ledger accounts in the forefront and different ledger accounts in the backdrop and some ledger accounts in between. On what basis they prioritized? And last but not least, the most important thing, accounting treatment of provision for taxes. Accounting treatment of provision for taxes. That is another important area. So, because all companies need to pay tax. Company itself need to pay tax, not the proprietor alone. But in other businesses, proprietor pays the tax and takes the profit in their return while filing their return. But here, company pays the tax. So for that, we can't say we need to pay the tax on the current year and we need to subtract that from profit and loss account. But here they have a practice of allocating some amount for the future tax payments. So that is where they give importance. So they have given a special provision for accounting treatment for taxation. Special provision. So let me take you to one by one. What is the meaning of the term company? Then what are the maintenance of books of accounts in company? Computation of managerial remuneration, dividend distribution rules, preparation and presentation of financial statements, and last but not least, the accounting treatment of provision for taxation. So I request you all to take your hints in your notebook, because this slide covers the entire backdrop of preparing final account. The entire lecture covers only these 6 points in depth with the reason behind for each rules and regulations. First, what is company? So we all must be knowing the word company. The word company derived from the Latin word com, which means together, and panis, with. So com means with, together, or panis. So we call that as for food, bread. In the earlier days in Latin word. As per section 2 of 20, as per the section 2 of subsection 20 of the Companies Act 2013, company means a company which are incorporated under the Act of Company or under any previous company law, then that can be called as company. A company raises funds from the public or few of the private owners, if it is a private limited company, and use it for their business. Hence, the company is more liable to the outsiders, to the investors. The company shares used to be listed, someone will buy, so they are liable for that. They are liable. So further, the company accounts gains major importance, and final accounts brings you a great picture of the entire company's operation. Now let us get into the different forms of owner in a company. So we have equity shareholders, preference shareholders, debenture holders, and venture capitalists, who are all the people who invest their money into the company for their business operation, for its business operation. So the company is liable to these persons in different form. So equity shareholders, they are highly liable. The company is highly liable to them. They are the real owners of the company. Preference shareholders, those all people also carry the equal rights to the shareholders, equity shareholders, but differs in taking decision, differs in voting. Debenture holders will get interest, not the sharing of profit. The debentures will be redeemed after these years, after their stated years, which we call as redeemable preference shares, redeemable debentures, etc. And the venture capitalists, sometimes they used to be converted as owners by acquiring the shares of the company for their capital amount. So the company is responsible to these people in different form, and the company is also responsible to the general public. So due to this reason, the final accounts for company gains a special significance than any other businesses. So that's why we have a subject called corporate accounting as a special paper. If we take sole proprietorship, we have financial accounting. It's a common for all, but corporate accounting is a separate paper to gain the importance of companies to showcase their financial statement, which are liable to many people, not only to the investor, they are liable to the investor, shareholder, debenture holder, borrowed monies. They are liable to the general public, they are liable to the government with respect to the payment of tax and sales of product. They are liable to the environment, they are liable to the social responsibility obligations. Hence, the final accounts of a company gains a special importance. Next, what are the maintenance of books of accounts? How the Company Act frames rules and regulations for, especially for maintenance of books of accounts. If we take sole proprietorship or partnership, the maintenance of books of accounts is highly flexible. They may have computerized books of accounts, they may have hard copies of ledgers, and they may have some other shortcuts to maintain the accounts, even in simple entry system. But in company, the company acts as advisors and gives their rules and regulations for maintenance of books of accounts in a legal way. As per Section 128 of the Companies Act 2013, every company shall prepare and keep at its registered office books of accounts and other relevant books and papers and financial statements for every financial year, which gives a true and fair view of the state of the affairs of the company. Please make a note. The section 128 brings out all the rules and regulations for the maintenance of books of accounts. According to this, every company shall prepare and keep its registered office books of accounts in a legal framework way, and all other relevant books and papers, and so importantly the financial statements also for every financial year. It's not that only last 3 years or only the previous year. It's not so, every financial year. And those statements, all the books of accounts and other relevant books, all the papers, gives a true and fair view of the state of the affairs of the company. Such books of accounts shall be kept on accrual basis only and should follow the methods laid down under the double entry bookkeeping system of accounting, but it differs in other businesses. Please make a note. It used to be there in multiple choice questions in the weekly quizzes on the Swayam platform. So when you keep all the accounts on accrual basis, it is must the company have to keep their accounts on accrual basis and follow the books of accounts according to the double entry bookkeeping system of accounting. And within that, they also advise us under section 128, subsection 5, further states that the books of accounts of every company relating to a period of not less than 8 financial years. Please make a note. That is so much important. Not less than 8 financial years immediately preceding your financial year. That means the current year. Apart from that, the company should maintain 8 financial years books of accounts, where the company had been in existence for a period less than 8 years. If in that case the company will need to maintain all the books of accounts in respect of all the preceding years, together with the vouchers relevant to any entries in such books of accounts shall be kept in a chronological order. So from this maintenance of books of accounts, we came to know one thing is that section 128 follows. You, as an accountant, are you maintaining the books of accounts as per provisions laid under section 128? Is that gives you true and fair view of the picture of the entire financial statement? Are these books kept on accrual basis or not? If not, then it cannot be agreed. Is that accounting system follows the double entry bookkeeping system of accounting? If not, then it cannot be agreed. And every company should maintain at least, it means not less than 8 financial year immediately preceding a financial year. Now, let me take you to the third part, which is most important. Even we get many sums problems in final account with respect to this, and even any final account without these adjustments it will not get fulfilled. That is none other than the computation of managerial remuneration. The computation of managerial remuneration. Managerial remuneration is calculated as a percentage on profit. Everyone knows this. Some percentage used to be given and remuneration can be calculated. But how it is fixed? That is the most important. The managerial remuneration payable by a company is governed by various sections. Under Section 197 and 198 of the Companies Act 2013 and Schedule 5 of the Companies Act 2013 also says it covers the managerial remuneration payable. So what is the overall limit of managerial remuneration? As per Section 197, the total managerial remuneration payable by a public company to its directors, including managing director and whole-time director and its managers, in respect of any financial year, shall not exceed 11% of net profit. Please make a note, in multiple choice question this would be expected. So as per under Section 197, the total managerial remuneration payable of any financial year shall not exceed 11% of net profit. So it is the sum of total. So which means it may be paid to the directors, to the managing director, to the whole-time director or manager, all together. It should not exceed 11% of net profit. However, it has floated out a few reasons behind that and the guidelines. Net profit based on which the remuneration is payable shall be computed in the manner laid down in Section 198. So Section 198 of the Companies Act have laid down how to prepare the income statement and calculate the net profit. Accordingly, we need to calculate the net profit in which the maximum remuneration can be calculated. Not as like anything. As like any way you can prepare the financial statement, income statement and calculate the net profit. The net profit based on which the remuneration is paid shall be computed in the manner as laid down in Section 198. For the calculation of net profit, the remuneration of directors shall not be deducted from the gross profit. Shall not be deducted. If you deduct, then it is not right way. You have to exclude that in the gross profit because it is an indirect. With the approval of central government, the company in general meeting may authorize the payment of remuneration whichever exceeding 11%. So central government have to approve. The general meeting, the shareholders have to approve when the managerial remuneration exceeds 11%. Now, what is the individual limit of managerial remuneration? What is the individual limit? The remuneration payable to any one managing director or the full-time director or the manager shall not exceed 5% of net profit. It means total should not exceed 11%, payable to one managing director, one full-time director or a manager individually should not exceed 5% of the net profit. If it exceeds, then it is inadmissible. It is inadmissible expenses that have to be borne as their own risk. If there is more than one such director remuneration, for example, you have two managing directors, full-time managing, you have two full-time directors. So in that case, then it shall not exceed 10% of net profit to all such directors and manager taken together. So you have one-time managing director also, you have full-time director also, you have manager also. Then it shall not exceed 10% of net profit to all such directors and managers taken together. The remuneration payable to directors who are neither managing director nor the full-time director shall not exceed. That means it refers to the manager or any type of other directors. It shall not exceed 1% of net profit if there is a managing director or full-time director or manager. It shall not exceed 3% of net profit in any other cases. So this is how we need to follow, and please make a note all the percentages and where these percentages are applicable, why it is so. Then they also provided a Schedule 5 of the Companies Act. It consists of 4 parts. Part 1 deals with the conditions to be fulfilled for the appointment of managing director or full-time director or the manager without the approval of central government. Whereas the part 2 deals with the remuneration payable to managerial person by companies having profits and having no profits or even inadequate profit. So if you are able to pay the remuneration, then it should come under part 2. Then part 3, it specifies the provisions applicable to part 1 as well as part 2. What are the rules and regulations to be followed in part 1 and part 2. Part 4 deals with the central government power to enact any rules in the exceptional cases. Now let us discuss in detail the part 2, which deals with the remuneration payable to managerial person by companies having profit and not having profit or having inadequate profit. So that we will discuss in detail now. Now, part 2 of Schedule 5 consists of 5 sections. One is Section 1. It deals with remuneration payable by companies having profit. Section 2 deals with the remuneration payable by the companies having no profits or having profit but inadequate without the central government approval. If it is so, for example, where the effective capital is negative or less than 5 crores, then maximum remuneration payable is 30 lakhs as advised by the Companies Act. If the effective capital is 5 crores and above, but not less than 100 crore, the maximum managerial remuneration payable is 52 lakhs. When the effective capital is 100 crores, but not less than 250 crores, then managerial remuneration paid is 60 lakhs. When the effective capital is 250 crores and above, then 60 lakhs plus 0.01 percentage of the effective capital in excess of rupees 250 crores. So the company can pay the remuneration even if the company is having less profit or a loss. The above limits have been doubled if the special resolution is passed by the shareholders. It is hereby clarified that for a period less than 1 year, the limits shall be prorated. Here, effective capital means the capital which is directly involved from the shareholders. Let us learn the dividend distribution rules. So, what is dividend? What are the sources of dividend distribution? What is interim dividend, when it is possible to allow? What is company's declaration and payment of dividend rule 2014 says? And what is transfer to reserves? And what is capital reserve for distribution of dividend? So what is the rule for dividend on preference shares? What is the rule for dividend on partly paid shares? And what is the rule of dividend on policy in advances? Then how the dividends are paid? And how do they treat the dividend distribution tax in company? So these things we'll be discussing one by one. So dividend distribution is a lengthier topic. Dividend ordinarily means that portion of the divisible profits or reserves which is distributed among the shareholders of the company according to the number of shares held by each of them and the rights attached to them. Such a distribution may involve payment of cash, that is dividend, or may not, in the form of bonus shares. What are the sources of dividend distribution? As per section 123 of 123 of subsection 1, dividend shall be declared or paid by a company for any financial year only out of the following. Point number one, out of the profits of the company for that financial year, arrived at after providing the depreciation in according to the provisions of section 123 of subsection 2. Second, out of the profits of any previous financial years, arrived at after providing for depreciation in accordance with the provisions of that subsection and remaining undistributed. That could be reserved subject to fulfillment of conditions in companies under the Declaration and Payment of Dividend Rules 2014, or both 1 and 2, or out of the monies provided by the central bank, central government, or any state government for the payment of dividend by the company in pursuance of any guarantee given by that government. So during these conditions, the company may declare the dividend. Let me have a quick recap. Out of the profit of the company, point number one, out of the accumulated profit of the previous financial year after providing full-fledged depreciation as per the Companies Act, or both of the above, or out of the monies provided by the central government or any other form of state government in which they have guaranteed to pay the dividend. So in that cases, you can use these four sources to pay the dividend, declare the dividend. Next, what is interim dividend? When it is paid? The term dividend includes interim dividend as per Section 2 of Subsection 35 of the Companies Act 2013. As per the Section 124 of Subsection 3, the Board of Directors of a company may declare interim dividend during any financial year out of the surplus in the profits and loss account and out of the profits of the financial year in which such interim dividend is sought to be declared. In case the company has incurred loss during that financial year up to the end of the quarter immediately preceding the date of declaration of interim dividend, then such interim dividend shall not be declared at a rate higher than the average dividends declared by the company during the immediately preceding 3 financial years. So take the 3 financial year, what is that average dividend declared? So that should not be exceeded. So what is company's declaration and payment of dividend rules 2014? What it says? The rate of dividend declared shall not exceed the average of the rates at which dividend was declared by it in the 3 years immediately preceding the year, provided that this rule shall not apply to a company which has not declared any dividend in each of the 3 preceding financial years. The total amount to be drawn from such accumulated profit shall not exceed 1/10 of the sum of its paid-up share capital for free reserves as appearing in the latest audited financial statement. The amount so drawn shall first be utilized to set off the losses. If there is any existing losses, to set off that, we need to utilize that incurred in the financial year in which dividend is declared before any dividend in respect of equity shares is declared. The balance of reserves after such withdrawal shall not fall below the 15% of its paid-up share capital as appearing in the latest audited financial statement. So shall not fall below 15%. Please make a note. There will be a multiple choice question from this expected question. Not only here, whenever you go to enter the corporate accounting multiple choice question, these are expected. You attend either SWAYAM platform or NPTEL platform or any other platform, or even if you attend any government related eligibility test, if it covers, the corporate accounting covers as part of syllabus, then this question is most expected. No company shall declare a dividend unless carried over previous losses and depreciations not provided in the previous year that are set off against the profit of the company of the current year. Last, the loss or depreciation, whichever is less, in the previous years is set off against the profit of the company for the year for which dividend is declared or paid. With this, let me stop this and we will move towards the transfers to reserves. Before declaration of dividend, a certain amount need to be transferred to reserve. The Companies Act lays down some provision for that. Let us look into that. The Board of Directors are free and can appropriate a part of the profits to credit of the reserve or reserves as per Section 123 of Subsection 1 of the Companies Act 2013. The appropriation of a part of profit is sometimes made under law. For example, under the Banking Regulation Act, a fixed percentage of the profit of a banking company must first be transferred to the general reserve before any dividend can be distributed. Apart from appropriations aforementioned, it may also necessary to provide for losses and arrears of depreciation and to exclude capital profit as mentioned earlier to arrive at the amount of divisible profit. So here, what is capital reserve and how it is accounted in the distribution of dividend? Is that accounted? It is this reserve which does not include any amount regarded as free for distribution through the profit and loss account. It does not include securities premium and capital redemption reserve account should not be credited to capital reserve, and these accounts have to be kept separately in the income statement as well as the balance sheet. Only profits or a surplus of a capital nature can be credited to such a reserve. For instance, profit paid to incorporation, capital profit on sale of fixed assets, when these are not available for distribution as dividends in the circumstances where the profit on sale of a fixed asset has not been realized, or where the profit on sale of a fixed assets through realized is likely to be wiped out by the deficiency on the revaluation of other assets, where the articles of association do not permit the distribution of such profit as a dividend. The excess of the value of net assets or the price paid for the acquisition of the business, then also it can be treated as capital reserve. Profit on reissue of forfeited shares, anything held then it has to be treated as capital reserve. The credit balance in the capital reduction account can be converted into capital reserve. So in this, what I said, the fourth point, the profit on reissue of forfeited shares is treated as capital reserve is most expected multiple choice question. Now, how the dividend on preference shares are treated? Holders of preference shares are entitled to receive a dividend at a fixed rate before any dividend is declared on equity shares. That's why the capital itself is called preference share capital. But such a right can be exercised subject to there being profits and the directors recommended payment of dividend. Next, dividend on partly paid shares. Dividend is payable depending on the provisions in this regard that there may be in the articles of association. However, no such provisions are given. In such a case, the amount of dividend payable will be calculated on the amount paid up on shares, and by doing so, the dates on which the amounts were paid must be taken into account. The amount paid on dividend will have to be calculated on nominal portion of the amount. Then, if so long as nothing is paid upon any of the shares in the company, dividends may be declared and paid according to the nominal amounts of the share. In the case of first issue of capital, the holders thereof, unless precluded by the terms of issue, are entitled to receive the dividend pari passu with the SARS already issued. What is the treatment on calls in advance? Calls paid in advance do not rank for payment of dividend. Please make a note. Calls paid in advance do not rank for payment of dividends. As per Section 124 of the Companies Act 2013, where a dividend has been declared by a company but has not been paid or claimed within the 30 days from the date of the declaration to any shareholder entitled to the payment of the dividend, the company shall within 7 days from the date of enjoy expiry of the said period of 30 days transfer the total amount to a special account called unpaid dividend account. Please make a note. 30 days which is not paid or not claimed is called as unpaid dividend account. If it remains unpaid or unclaimed for a period of 7 years from the date of such transfer, then the amount shall be transferred by the company along with interest accrued, if any, thereon to the funds Investor Educational Protection Fund established under Section 125. So that's the name, Investor Educational Protection Fund. Dividend distribution tax. How to treat the dividend distribution tax. The dividend distribution tax is chargeable in any amount declared, distributed, or paid as dividends. It could be either interim dividend or final dividend or any form of dividend. Dividend is chargeable to dividend distribution tax by the out of the current profits or accumulated profits. The rate of dividend distribution tax is 15%, excluding the surcharge of 12% plus secondary and higher education cess at 3%. So it is 15% and surcharges, tax on tax. The dividend distribution tax shall be payable even when no income tax is payable by the domestic company on its total income. Even the domestic company is not earning a sufficient amount of profit to pay the income tax, but they are distributing the dividend, then they need to pay the dividend distribution tax. Dividend distribution tax is payable to the credit of the central government within 14 days of declaration, distribution or payment, whichever is the earliest. The tax have to be paid within 14 days. Please make an underline. The 14 days. Write that in your notebook, underline, because it used to be there in multiple choice question in Swayam. According to generally accepted accounting principle, provision for dividend is recognized in the financial statements of the year to which the dividend is. In view of this, dividend distribution tax on dividend and income distribution tax is leviable on gross dividend or income and not on the net dividend or income distributed to shareholders. So now, how to calculate the corporate dividend tax? For example, X Limited, a domestic company, has distributed their dividend on 5th April, a dividend of rupees 230 lakhs to its shareholders. That means 2 crore 30 lakhs. Compute dividend distribution tax. Simple, out of 230 lakhs, and the increase for the purpose of grossing up of dividend, which means 15 percentage. So before 15 percentage is 230 lakhs, then after 15 percentage, how much it could be. So the tax would be part of the dividend. So we need to gross up the dividend by multiplying 230 with 15 divided by 85, which means it is a grossing up. So 15 is the tax purpose, 40 lakhs 58,000. So the total gross dividend is expected to be 270 lakhs 59,000. And dividend distribution tax at 50 percentage out of 270 lakhs 59,000, it comes around 40 lakhs 58,000. And add surcharge 12 percentage, and add surcharge for education cess and secondary higher education 3 percentage. Altogether it comes around 46 lakhs 83,000. So this is how the dividend distribution tax has to be calculated. Now, on the fifth part, preparation and presentation of financial statements. For preparing final account, under section 129 of the Companies Act, at the annual general body meeting of the company, the board of directors of the company shall lay the financial statements before the company. The financial statements as per the section 2 of subsection 40 of the Companies Act 2013 include a balance sheet as on the end of the financial year, a profit and loss account, or in the case of a company carrying on any activity not for profit, an income and expenditure account for the financial year. And third, the cash flow statement for the financial year. The fourth, the statement of changes in equity, if applicable. If not, then no need to have. Then any explanatory note annexed to or forming part of any document referred in subclass 1 and to subclass 4. What are the requisites of financial statements? What are the provisions available? So for all these things, we need to keep some of the points in our mind while preparing the final account. The point number 1 is the requirements of Schedule 3 to the Companies Act. Then other statutory requirements. The third, accounting standards issued by the Institute of Chartered Accountants of India on different accounting matters, and notified by the central government from period to period between Accounting Standard 1 to 32. The statements and guidance notes issued by the Institute of Chartered Accountants of India, which are necessary for understanding the accounting treatment, valuation, disclosures suggested by them. And then last, the Electricity Act 2003 does not specify any format for presentation of financial statements. Therefore, Schedule 3 of the Companies Act 2013 is followed by the electricity company in preparation of their financial statements. Thus, problem-solving exercises will take care of the format of financial statement in the later stage of our lecture. Now, let me take you to the sixth point, the accounting treatment of provision for tax. The provision for tax for current year is deducted from profit before tax to arrive profit or loss for the period in the profit and loss statement. Provision for tax has to be shown as a supplying item of short-term provisions under the head current liabilities. Advance tax deducted at source, is shown as a supplying item of short-term loans and advances under the head of current assets. Short provision of income tax for the previous year has to be deducted from profit before tax to arrive profit or loss for the period in profit and loss statement. No impact in the current year balance sheet. Excess provision of income tax for previous years have to be adjusted or have to be added to the profit before tax to arrive profit or loss for the period in profit and loss statement. So no impact in the current year of balance. Advance tax and tax deducted as source, which has the debit balance, are usually adjusted against the income tax liability at the time of settlement of liability for income tax. The payment of income tax against the demand which the company wants to file an appeal, and it should be treated like payment of advance tax till the appeal is pending. So these provisions need to be taken for accounting treatment of provision of tax. So there we have a standard journal entries which have to be followed for the provisions. On making provision for tax for the current year, we need to pass a journal entry called a profit and loss account to debited to provision for tax account. Next, on adjustment of short or excess provision for tax for previous year. In case of short provision, then P&L appropriation account debited to provision for tax account. In case of excess provision, then the same journal entry have to be reversed, which means provision for tax account debited to profit and loss appropriation account. When you convert the provision into a liability on settlement, then you can convert the provision for tax account debited to income tax payable account. Next, on adjustments of advance tax and tax deducted at source, which has the debit balance, then we can pass the following entry: income tax payable account debited, income tax refund due account debited, and 2 advance tax account, and 2 tax deducted at source account. Next, on payment of balance of tax payable if any, then income tax payable account debited to bank account. Next, on receipt of income tax refund due, if any, this is not compulsory. If it happens, then we need to focus on this. Bank account debited to income tax refund due account. So with this, let me conclude and bring you the summary, a short summary of the first class of final account. So here in this class, we learned what is the meaning of company, why does the company requires the financial statements in a specific form, and then we know how to maintain the books of accounts in different way. And third, we learned how to compute the managerial remuneration. So how that a Companies Act have laid down in different rules, provisions, etc. Then fourth, dividend distribution rules. We learned about that. Definitely there will be multiple choice questions on these part. Preparation and presentation of financial statement. This is another important area we learned. But in this we did not see each schedule, each part, each notes of accounts, because it comes when preparing and solving the sentence. Last, we also learned the accounting treatment for provision for taxation along with the specific journal entries. So with this, let me make a call to all my students to make all the important notes and appear for multiple choice questions in the upcoming week. And everyone are expected to get at least 15 out of 15. If it is 12 questions, are they 12 out of 12? Because the standard questions have been posted in this final platform, you can easily appear for that. Have a good day and let us meet the next week in solving the final account sums, in calculating the managerial remuneration, in computation of general reserve to be transferred. So all these things will be there in the upcoming class. And thank you. Have a wonderful weekend.